Hello, everyone. Welcome to the Q4 2024 Market and Economic Overview. Hope everybody is doing well and Happy New Year. Want to give a market update on kind of everything we experienced throughout the year and just touch on some additional things that we're looking at into 2025. But by most measures, markets performed really well in 2024. The world economy, definitely led by the US, it demonstrated strength all year. As a result, equity markets performed well. Global stocks were up double digits for the second year in a row. It continues to be our base case that the global economy will not fall into a recession in 2025. We've been encouraged by the inflation trends, the stability of the labor market, and also the continued strength of the consumer. But want to take you through some slides that show the performance of markets and then just some additional things that we're looking at and also reflect on changes that we made throughout the year. So here's a 5-year chart that we've all seen of global stocks. 2024, you can see was strong. There were a couple blips throughout the year, but the trend was forcefully up. And numerically, global stocks were up almost 19%. And you can see across all areas of the market, there were positive returns, definitely led by the US and definitely led by growth areas of the market and specifically large cap growth, which has been a common theme over the last couple of years. International markets, while positive, lagged the rest of the world. As you can see, their returns are muted relative to different areas of the US market. But all in all, great year for equities. This is a 5-year chart of the global fixed income market. Remember, interest rates and bond prices or fixed income prices are inversely related. So when rates rise, which is what we saw in 2022, we saw bond prices fall. Stock markets, as we remember, also fell in 2022. So it was a very frustrating year for investors. 2023 was better. 2024 has been kind of better yet, as we've gotten a little alleviation of interest rates as they've came down a little bit lower. And the Fed has started to cut rates over the last 12 months. So over the last year, global bonds were up about 3.5%, US bonds up about 1.25%. You can see the 5-year numbers, which factors in 2022 and before, basically flat, right? So as we kind of look back over that 5-year period. So both stocks and bonds in 2024 were positive. Fed rate cuts. So this has been a topic that a lot of us have been thinking about and questions that we've gotten. So the Fed, just to take us back, took rates from 0 to 5%, and then they finally cut interest rates this year. They went 50 bips or 0.5% at the start of Q4, and then cut 2 more times through the end of the year. So as we stand today, the Fed funds rate is at about 4.25% to 4.5%. The blue line is where the market prices Fed funds rate to be at the end of 2025. And the red line is where the market prices Fed funds to be at the end of 2026. So slower pace of cuts are expected into next year. You can see the deviation between where Fed funds rate is today and where the market expects it to be. There's a smaller gap than what we kind of saw at the beginning of the year and in the middle of the year. And then some proposed policies that is in the new administration. We kind of broke out 4 of them and their economic impact. So tax cuts and deregulation tend to have a positive impact on growth. Tax cuts do kind of put upward pressure on inflation. Tariffs and immigration policy tends to have a downward pressure mechanism for growth. On tariffs, we initially see inflation pressures kind of pressed higher and then down, and then with the immigration policy, inflation also up. So these are things that we're monitoring and paying attention to kind of what areas of the market that it might impact. And then where we stand with client portfolios today. So again, we're actively managing client portfolios. The TrustPoint investment team is actively managing Emerj360 client portfolios. So as we stand today, we're slightly overweight equities relative to our target. So if you're in a balanced growth strategy where we target 50% stocks, We're currently at about 52.5% stocks, 47.5% fixed income. So we slightly favor equities relative to fixed income. As we said, our base case is that the global economy will not fall into a recession in 2025. So we're looking at areas of the market to kind of allocate throughout the year that maybe didn't do as well the last 2 years, so we can capitalize on markets and economies doing well. And these are just the summary of the changes that took place. So on average, we'll make about 3 to 4 changes a year within client portfolios. Again, that is really dictated by the opportunity that the investment team sees out in the marketplace, whether that's on the opportunity side or on the risk side. So there was one final change made. I know we talked about the changes in previous overviews in January and March. In October, there was a final change made that kind of officialized our slightly overweight positioning to equity markets. So we became overweight equity allocation due to drift, meaning that equity markets drifted higher more than fixed income markets, and we had a broader earnings outlook and improving economic outlook as well. Shifting some allocation from small to mid caps due to structural changes within the small cap universe and aligning portfolios more with the broader market. We removed real assets, which would generally hedge within client portfolios, and then a little bit on the fixed income side, reduced duration as the bond market is priced in a more aggressive interest rate easing path than we may have anticipated. So again, this was in October. Our ideas are always evolving within the investment team here at TrustPoint. So it's why we like to give these quarterly updates to let everyone know kind of behind the scenes what TrustPoint is thinking and any changes that are being made. So thanks everyone for listening. We appreciate all of you as clients. Thank you for being clients. We look forward to a great 2025. And as always, please reach out with any questions that you have. Would be happy to have a conversation around markets or anything else that is on your mind. Thanks, everyone.